Welcome back. We are coming to you live from Davos, and one of the major conversations on the ground is about the potential for a recession, both global and domestic. Many in Wall Street laying off thousands of employees recently, including banks like Goldman Sachs and Morgan Stanley. But Bank of America, the complete opposite, not performing layoffs. We want to talk more about how he sees things. We are live right now with the chairman and CEO of Bank of America, Brian Moynihan. Brian, it's great to see you.
It's good to be here again.
Thanks.
It's good to be here with the beautiful views and the snow behind us.
It is gorgeous, this view. It sure is. What are you doing in terms of this labor market? We talked before about the tightness of it, such pressure on wages and on people, but a lot of your colleagues in the industry are cutting jobs. Are you?
So we will be very careful managing headcount and manage it back down. So the way to think about that is in the first quarter of last year, we had to hire 4,000 people in a month once to replace the people. The amount of people leaving our companies dropped in half, so we have to slow down the hiring and bring the headcount back down. It got too high, and I told the team slow it down, and they're doing it. And so we keep the critical staffing, we keep the people we need, and we just really watch it. But look, we can manage that with a 10% turnover rate and 215,000 people. We have to hire 5,000 people to keep the number of headcount stable. So what you do is just slow down the hiring and let the headcount drift to where you want it to be.
Give us a sense of loan demand right now and loan growth. What are you seeing?
So we saw in the fourth quarter, moderate loan growth. Year over year, we saw big loan growth, but that's partly the recovery from the pandemic. We look forward, we say mid-single digits. But if you look at that, as companies have gotten more careful thinking about the forward view, you've seen the line of credit usage by a company has come back down a little bit, which is interesting. Our small business demand is still very strong. Our consumer demand is okay. Mortgages obviously are down just because the rates change. So overall, it's okay. But I think in the corporate side, all the talk you're hearing here, I want to be a little more careful. I want to be a little more planful. I want to make sure I didn't miss my view of the economy, not my view, but the company's view. And so it's okay and it's solid. We'll get mid-single digits, but that's more normal. I mean, we've recovered from the pandemic, and you have to remember, growing loans, at 10%, 15% rate is not what a big mature business does.
Yeah, I want to get a sense of where the loan growth is coming from. Is it largely from mid-cap companies who are basically saying, look, we were doing just in time, but now we're doing just in case because of the supply chain issues that we saw last year? Or is it the consumer?
It's both. And so, again, mortgage lending down, credit card lending up a little bit because of consumers, especially around the fourth quarter, use their credit cards more. And the corporate side, I'd say the SME market, as so-called, the small mid-sized companies, is solid. Large companies that go to market, the market shut down for leverage finance, and that's been interesting to get through. But so it's just solid. But our spending and the activity is more consistent with a lower growth economy and a more normal economy. Inflation's not over yet, but what you're seeing, the activity is starting to show because the Fed raised rates a lot to slow down the economy, and that's what you're seeing.
And in a really quick way.
Absolutely.
I mean, we've had zero rates for so long, like a 15-year period, and all of a sudden in a year, they're speeding going from 0 to 5%.
I heard Howard early. It's a 5,000-year low in rates, according to one of our analysts. I don't know how they counted, but 5,000-year low in rates, and they've got to come off the bottom at some point, and Howard's points are exactly appropriate. The rate structure has to get back to a more normal situation, and you're seeing that happen, but it'll take a few years to get there.
Which is why you're pushing back on any idea that the Federal Reserve will start cutting rates later this year. How long can you continue to capture this incredible move with rates where they are and no movement in deposit rates? I mean, are you going to be forced at any time to raise the rates on deposit accounts?
Well, we already have. It depends. The businesses are very different. In a zero-interest checking account, zero interest means it never pays interest because a huge transaction, all the services, 3,000 branches, 18,000 ATMs, so that's a zero-interest checking. You go over to the money people have put aside to sort of stored the cash but put it back out to save, that's already moved. And that largely happened during last year. So the third quarter end to fourth quarter end, the deposit balances are flat. On the rate side, the rates kicked up on the, because the mix of higher rate deposits for the corporate customers, for the wealth management customers went up, and then even the consumer customers. But what drives our NII growth is the fact that we have 35 million households in America who do the core account with us, and we grew that by 1 million households last year.
Wow, and that's the kind of account that people don't move so easily. I mean, you got your money in a savings account, you're good. You're not moving it.
And by
Even
the way,
though you don't make any money on it.
And by the way, those consumers have in their accounts a lot more they had pre-pandemic because the stimulus is still being spent. It hasn't been spent. And so in the raises and because of labor market tightness that we've all given to keep up with inflation. So what's interesting is you look at those accounts pre-pandemic, there's in the people who are sort of median income, they're multiples of where they were. They've come down a little bit since the spring of last year, just slightly, but they're basically still multiples where they're pre-pandemic. So that means that U.S. consumer still has a lot of purchase power, although the fight about inflation is things get expensive, it hits them right in the pocketbook, and then they start to change their behavior.
Of course. I want to get your take on two areas that you mentioned. Housing, obviously, we've seen real demand destruction, and also the capital markets and this, lack of, equity and debt raises. I want to get your take on what that recovery looks like, but we'll take a short break and come back with that. Welcome back, and I am back with the Chairman and CEO of Bank of America, Brian Moynihan, here in Davos. Brian, I want to talk about the macro story. First off, you've been expecting a real slowdown, a moderate recession. Where are you today on the macro story in terms of recession? And what about housing? How bad has it been? You've seen a lot of these cycles. How long does it take for this recovery to take hold?
So two things. On the macro, we basically have a mild recession predicted starting mid this year into 24. We expect that it takes the Fed will move rates up over 5% and hold them there all through pretty much next year. Unemployment will move up a little bit. And so that's how they have to slow down the economy. And I think people are debating about pulling them back down. They can't pull them back down to the services side, inflation squeezed out, which is much more difficult. On housing, look, if you basically double the cost of a mortgage, obviously housing prices are affected, but people forget in the context that was in the last guest that I talked about, which is Howard was talking, at the end of the day, it went up dramatically, and now it's going to come back to get on long-term trend. And so if you go back to 2004, 5, 6, 7, it rocketed up, it came back, got on the 3% trend, and that's because the population in the U.S. is fairly stable. There's houses that are needed in certain places. At the end of the day, there's not that much aggregate demand, and so rates slow it down, but that's the intended outcome of the Fed changing rates.
Yeah.
If we didn't slow down housing, people would have this wealth effect that would probably feel more like 2007-8.
And then we'd probably get more 75 basis point hikes,
exactly.
Right? If it didn't impact it. What about capital markets? It was dead in the water last year. You know that. No capital, not a lot of capital raises and debt and equity, IPOs. I think there were 35 IPOs at the New York Stock Exchange. How long does that recovery take?
Well, it's you need stability. You need the projections of the economy to stabilize, earnings projections to stabilize, the rate structure stabilize, especially on the leveraged finance side. And that's starting to happen. You're seeing some stuff get through that is not as needful of some of those pieces. But, we went from $2 billion a quarter investment banking fees for all that activity to $1 billion. Now, we used to be about 1.5, so it's not like the life ended. And we're down, you say down 50%, you feel good, you gained a little market share. But on the other hand, look, we have a balanced book of business. We do corporate lending, we do treasury services, and we do investment banking, and it'll come back. It's just going to take some stability. So when people are debating whether the Fed's going to be cutting rates at the end of the year or raising rates at the end of the year, that's not the time when you take a company public easily. You can get some public, but not easily.
Well, you are a major lender for business, and the number one in terms of middle market customers. And I want to get your take on this because a number of oil and gas related companies are worried they're going to shut them down. This week and Davos, you said this. You said the official global standards on sustainability and climate were needed to align capitalism with what society wants from it. Are you buying into these global standards? Are you going to stop lending to oil and gas companies?
Yeah, we have $40 billion outstanding loans to oil and gas companies. We do capital markets transactions. 2 days ago, there was an article written how that we are one of the major funders. We fund oil and gas companies. And those leaders, include Vicky, I just saw from Occidental and talking to her, those leaders are trying to transition to companies. Carbon capture storage. Went out to North Dakota with Senator Kramer. They have a net zero commitment where they're taking the carbon capture and sticking it in the Bakken shale, in the pipelines, and we're helping people figure that out. Look, we need to have both. We need lots of oil and gas, energy security, and we need to start to make the transition. The key is to keep it all in balance. On the standards, the issue is right now we're about ready to be handed a set of standards by Europe that will apply to American companies, subsidiaries here, and ultimately companies, the SEC. And so what we're trying to say is the private sector for the last 4 or 5 years said, here's a set of standards which are straightforward. Adopt these. We have 200 companies already disclosed on them. But don't take us in all these different directions, because then we can actually drive the private markets. Capitalism will solve these problems if you let it go.
Yeah.
If you try to micromanage it, if you try to take it away, it's done. Secondly, with the IRA Act in the U.S., the U.S. can now dominate this question of making this transition work from energy supply, energy security, getting them to ship to Germany, critically important for Germany to help hold themselves in to fight the war. In the conversations between Germany and the U.S. oil companies, we actually participated in those to say, talk to each other. They need supply, and out it goes in those. And so think about that dynamic. And the question is, but we have to get the environment piece right, or we'll start being taxed taxed on environmental issues and stuff. So we're trying to get the balance.
Germany's building coal plants.
Because they made a mistake about single source of supply. They freely admit that. Yeah. Now they're diversifying their supply, and then they're continuing to deploy wind and others. But what they're really doing is bringing LNG out of the United States, and that's a great opportunity for us. On the other hand, about 18% of all the clean energy in the United States runs for us. It's Texas, it's Oklahoma, the wind, the solar. Yeah. That's where we do this stuff. And so it's a wonderful thing. And with Kevin and others, had him talk to a group of CEOs about this. There's a balanced view here. We can drive it. Even Senator Manchin, I heard the clip there. We need all. Yeah. And we need to drive everybody there. UAE, COP28, that's a lot of controversy. We believe that oil companies have to be at the table or else it won't happen.
Yeah, I mean, we spoke with Senator Manchin yesterday. Obviously, West Virginia, an important state when it comes to this production. Here's what he said about getting to the other side. Watch this.
I do not subscribe that you can eliminate your way to a cleaner environment. I subscribe that you can innovate your way to a cleaner, less carbon. But you're going to recognize you've got to have the horsepower to run the country.
Your reaction?
By the way, Kevin Cramer would say the same thing. We got to innovate and drive innovation. At least he said it to me on many occasions. And so I think there's a big middle here to drive this change. And what Senator Manchin is saying important in that state, a big battery facilities going in right now. In our state, we built a big solar installation with Duke Power to supply. And so there's just a lot of great activity can happen here. There's a sustainable aviation fuel plant that is coming out of the ground in eastern Georgia that we finance that adds sustainable aviation fuel into the network in the southeast. A micro of what we ultimately need. But a plane can fly on it with no change to infrastructure. How cheap is that? Yeah. And that's what we're trying to figure out from a business standpoint. If people give us a bunch of standards that take us off in directions, what we're saying is get to a common set of standards that the business community agrees with, and let's go.
Real quick, Brian, before you go, we talk capital markets. Are bonuses going to be down big this year?
I'd say, look, for the 99% of our employees, they're going to have a good, solid year. Their income's going to be up. There'll be the top of the house. When the stock's down, we have to take it. And when the revenue-based business that the investment bankers are, it's clear what could be the other outcome. But at the end of the day, we're shareholder-focused. We made $27.5 billion. The team had a good year. So I think our broad-based team will be in pretty good shape.
It's about performance.
By the way, last 4 or 5 years, remember, we've been giving shares to our teammates, all 200,000 every single year.
I like that.
We'll see what happens. We've got to get through the board, but that's pretty amazing. It's over $1.5 billion. It's basically $900 million of stock every year we've been giving to while we reduced our share count. That's capitalism work.
And it's more incentive into the company.
You got it.
Because they have a stake in it.
Yeah, exactly.
Brian, it's great to see you.
Good to see you.
Thanks so much. Brian Moynihan, Chairman and CEO, B of A.